Warren Buffett, worth over $100 billion, relies on one financial statement to find companies that print cash like ATMs, a statement most other investors completely overlook. In Warren Buffett and the Interpretation of Financial Statements by Mary Buffett and David Clark, they reveal Buffett's secret weapon, the cash flow statement. Here's the kicker. A company can show huge profits on paper and still go bankrupt because profit doesn't equal cash, and cash is king. Stay till the end as I break down 8 key lessons that will transform how you read financial statements forever. Here's Warren Buffett's golden rule. Never invest in a business you cannot understand, and always follow the cash. While the income statement can be manipulated with accounting tricks, and the balance sheet is just a snapshot in time, the cash flow statement shows you the real money flowing in and out of a business. Buffett looks for companies with strong operating cash flow, minimal capital needs, and growing free cash flow year after year. These moat businesses have durable competitive advantages that generate cash on autopilot. Now, let me break down the cash flow statement structure first, then dive into the key lessons. Let's understand the 3 sections of the cash flow statement. Think of it like tracking your personal bank account. Money comes in, money goes out, but from different sources. Section 1. Cash flow from operating activities. This is the heart of the business. It shows real cash generated from core operations like sales, minus payments to suppliers, employees, interest, and taxes. Key question: is the company making real cash from what it actually does? Section 2. Cash flow from investing activities. This shows how the company invests for the future, including CapEx on property and equipment, buying or selling investments, acquisitions, and asset sales. Key question: is the company investing wisely for growth, or bleeding cash on bad projects? Important note, this section is usually negative for growing companies, and that's okay. Spending on CapEx means they're investing in future growth. Section 3. Cash flow from financing activities. This shows how the company raises or returns money, through debt, share issuance, buybacks, or dividends. Key question: is the company creating value for shareholders or desperately raising money to survive? If a company's operating cash flow is strong, it can fund its investments and return money to shareholders without taking debt. That's a Buffett-style business. Now that you understand the structure, here's Buffett's first rule. Operating cash flow should consistently exceed net income, because net income uses accounting tricks, but cash is real money. Asian Paints, FI 2023-24, shows 4,200 Indian rupees crores operating cash flow versus 3,800 crores profit, meaning customers pay on time and real cash flows in. Contrast this with Vodafone Idea. Chronic losses with negative or barely positive operating cash flow, they're burning cash from operations. Buffett's rule: if operating cash flow is consistently lower than net income, the profits might be on paper only. The company could be recognizing revenue before collecting cash. Danger zone. Your action: always check if operating cash flow is greater than or equal to net income. If not, dig deeper or walk away. Lesson 2. Here's where Buffett separates winners from losers. Capital expenditures. Is the cash a company spends on equipment, buildings, technology, stuff needed to keep the business running? You'll find this in the investing section of the cash flow statement. Buffett's preference: low CapEx businesses.
Why?
Because they don't need to constantly reinvest massive amounts just to stay alive. Examples: high CapEx businesses. Tata Steel, airlines like Indigo, and Reliance Jio need thousands of crores for heavy machinery, aircraft, and infrastructure. Low CapEx businesses. TCS, Infosys, and HDFC Bank run on laptops and rented spaces with minimal capital needs. Buffett's formula: free cash flow equals operating cash flow minus CapEx. Now, let's look at the real numbers of TCS, for example. Operating cash flow: 58,000 Indian rupees crores, CapEx 3,000 crores. Free cash flow: 55,000 crores. That's 55,000 crores they can use for dividends, buybacks, or growth. The magic number: if CapEx is less than 20 to 25% of operating cash flow, you're looking at a capital-light business model, Buffett's favorite. Your action: calculate CapEx as percent of operating cash flow. Lower is better. Lesson 3. Let me make this crystal clear. Free cash flow is more important than profit because it's actual cash available for dividends, buybacks, debt repayment, acquisitions, and building reserves. Buffett's checklist. Is it positive, growing yearly, and above 10% of revenue? HUL example. FI 2023-24 shows 60,000 Indian rupees crores revenue generating 9,800 Indian rupees crores free cash flow, a stellar 16% margin, which funds 8,000 to 9,000 Indian rupees crores in annual dividends, occasional buybacks, with cash still left over. Contrast Patum shows revenue growth but negative free cash flow for years, burning reserves and repeatedly raising capital just to survive. Buffett's warning. If a company has negative free cash flow year after year, it's like a car running on fumes. Eventually, it'll need to refuel, raise more capital, or stop. Your action. Track free cash flow over 5 to 10 years. Is it positive and growing? That's your green light. Lesson 4. Now here's something crucial for Indian investors. Why buybacks can beat dividends. Dividends. You get cash directly but pay up to 30% tax immediately based on your slab. Buybacks. Company reduces share count, your ownership percentage increases automatically, shares become more valuable, and you pay zero tax until you sell. Quick math. Own 100 shares worth 1 Indian rupee lakh. With a 10,000 crore dividend, you get 10,000 minus 30% tax equals 7,000 in hand. With a 10,000 crore buyback, your ownership increases, share value rises, and you keep it all tax-free until selling. Buffett's wisdom. Buybacks are wonderful when shares are below intrinsic value and foolish when above. Your action. Check if the company does buybacks. If yes, check if they're buying when stock is cheap or expensive. Smart buybacks equals smart management. Lesson 5. The third section of the cash flow statement, financing activities, is where you spot trouble or greatness. Financing activities show you. Is the company borrowing money, issuing debt? Is it issuing new shares, diluting your ownership? Is it paying dividends or buying back stock? Buffett's warning. If a company is constantly issuing debt or new shares just to stay afloat, that's a sinking ship. What you want to see. Share buybacks, reducing share count, dividend payments, rewarding shareholders, debt paydowns, getting stronger. Example, red flag. In recent years, Z Entertainment has taken significant debt shown declining operating cash flow struggled to service debt. When you see operating cash flow declining but debt increasing in financing activities, warning bells should ring. Your action. Look at 5-year trend in financing activities. Is the company constantly desperate for cash? Or confidently returning cash to shareholders? Lesson 6. Here's a pro tip from the book. Never analyze a company in isolation. Buffett always compares cash flow metrics across competitors in the same industry. How to do this? Pull up 3 to 5 competitors in the same sector, compare their operating cash flow margins, operating cash flow divided by revenue, compare their free cash flow yields, look for the consistent outperformer. Your action. Always compare within the sector. The company with the best cash flow margins usually has the strongest competitive advantage. Lesson 7. This is critical and where most beginners fail. One good year means nothing. Buffett doesn't look at last year's cash flow. He looks at the last 10 years. The book's advice. Pull 10 years of cash flow statements. Is operating cash flow positive every year? Is free cash flow growing most years? Are there any years with massive cash burn? Your action step. Don't invest based on 1 year's performance. Demand a decade of proof. Use tools like Screener.in or TickerTape to pull 10-year data easily. These tools apply to Indian companies, not to other countries. Lesson 8. Here's the final truth bomb from Mary Buffett and David Clark. The cash flow statement is the hardest financial statement to manipulate.
Why?
Because it tracks actual cash movements. You either have the money in the bank, or you don't. The income statement. Companies can use accrual accounting to recognize revenue before cash is collected. The balance sheet. Asset values can be subjective and inflated. But the cash flow statement? It's black and white. Your 3-step verification. Start with the cash flow statement. Is cash actually being generated? Verify the story with the income statement. Are profits real? Cross-check with the balance sheet. Is the company getting stronger? If the cash flow looks weak, walk away, no matter how profitable the company appears on paper. Finally, here is your cash flow checklist. Take a screenshot. Remember, investing isn't about finding the hottest stock or the next multi-bagger. It's about finding businesses that generate cash reliably year after year, whether it's TCS in Mumbai or Coca-Cola in Atlanta. Let me leave you with this Warren Buffett quote: "Price is what you pay. Value is what you get." And value, it's measured in cash flow, whether you're buying TCS or Tesla. If you found this helpful, hit like, subscribe. Thanks for watching. This is Guide to Wealth, where powerful ideas meet practical action.